Welcome back. We're here at the Real Estate Roundtable with IPRG, and today we're going to talk about what's going on in the financing markets. There's a lot of stuff that's been going on in terms of rates going up, and the Fed raised the Fed funds rate again recently, last week. There's new numbers out for CPI. We want to talk about how all this plays in with each other. But today we actually brought in our first guest to the podcast. So today we have Jason Au here from Au Consultants, which is a real estate capital advisory firm. Welcome, Jason.
Thank you. It's an honor and a privilege. So I appreciate you guys inviting me in and having me. And it's great seeing everybody again.
Yeah, for sure.
So, yeah, 100%. It's an honor and privilege for us to have you here. And just as a quick anecdote, we have a lot of personal experience with Jason. We've personally closed probably in the neighborhood of like 10 loans with Jason. Those are acquisition loans, refinances. We've done some construction financing as well. So, thank you for everything. You've always done a really good job. You've always gotten the deal done. We feel really good about all the transactions we've been able to close with you.
I appreciate it, and I appreciate you giving me the opportunity to work for you guys. And let's jump right into it. We don't need to.
I'll throw one thing in real quick. I think what makes Jay so good, it's organization, right? Like obviously anyone that's done a bank loan or a refinance or whatever. I mean, there's a lot of paperwork involved, and every time we've worked with Jay, I don't have to worry about a single thing, right? Like it's all our things are already done, all the paperwork's already organized. Doesn't have to re-ask for tax returns and everything, and he holds our hands and gets it done. It's not a lot of stuff, not a lot of things that we have to do, and we're working with him, so that's always helpful.
Let's just talk about one of the deals that we're doing right now.
Yeah.
So he's also gotten us deals that we just couldn't have gotten elsewhere.
No.
Like Luke and I bought a property in a 1031 exchange, and Jason took care of the acquisition financing. The property, is delivered vacant, so we're gonna redevelop it. And Jason took care of the construction financing. Both loans came from a bank, so it wasn't a hard money lender. And I mean, the bank rates for I don't even know what you call this, a bridge.
It's it's a bridge loan plus construction loan. But your deal, the way that you guys explained it to me, was a little unorthodox from what people wanted, because you were doing the exchange and you had a substantial amount of money that you were going to put down on the property. So you wanted to use that equity that you were putting in towards the construction loan portion. So we were able to get you, how much did we get you? 65 or 70?
We had a low LTV on acquisition.
Right.
And then we have I think our LTV on acquisition might have been like 60 or 65%, but then we're getting like 80 or 90% of the construction financing, which is going to bring the bank all in. I think it's 70% loan to cost.
Correct.
Okay.
Which is great, especially today.
Yeah, so we did this deal, I guess, over the summer. We're still closing the construction financing now. But in terms of let's just talk about the rates that we got here. Do you recall the rate that we got on the acquisition?
So the initial acquisition loan we closed at 5.25%.
Sounds right.
And now your construction loan, because it's a construction loan, it's prime floating. You're going to close it at 8.75.
8.75 which is paying for 70-80% of our construction costs, depending on how much we end up spending at the end of the day.
We'll see what we end up spending. So it's always more than what we anticipate, but that's what it is.
On paper, I forget the percentage.
That's a different topic on contractors.
Yeah, that's contractors. That's not us.
But yeah, I mean, so what is it, 8.75% on construction?
It's prime plus 1.75. So, what they just raised the Fed fund rate, so the prime rate adjusted with that. So now prime rate is 7%.
Prime is 7?
And your spread is 175 over prime.
What is prime?
7%.
But what is prime? Why are they using prime?
So prime usually just goes up when the Fed when the Fed raises the Fed fund rate. So it's just a U.S. prime rate that is an index that a lot of lines of credits are based on, a lot of construction loans are based on. It's just another index, kind of like SOFR, LIBOR, and MTA, and all those other indexes. And a lot of the banks use that to do their construction loans based on that.
Is there prime across the board for banks usually the same? Is there like a standard?
It's standard Wall Street U.S. prime rate.
Got it.
All right, we'll get into the rates. And I know there's a lot of talk about the Federal Home Bank rate and the Treasury rates, whether it's the 5-year or the 10-year. But anyway, I mean, let's just say that we didn't get bank financing for this transaction. And again, we're so appreciative and so happy that we were able to. But if we had to go the hard money route and just go to the private markets, how much would we be paying for the construction aspect of this deal at this point?
I think you'd probably be well into the 12 or 13% range.
Yeah, I think so too.
You guys looked at that option. I remember before
We did before all of it.
before we dove into the bank financing, and it was I think it was prime plus 3 or 4 at the time, and it was like 8 or 9%.
Correct.
And I was able to bring you into a bank to do the bridge at 5%.
Interest only, yeah.
Interest only.
So you called the main loan the bridge?
Yeah.
Got it. Okay.
Because it's only 2 years.
Yeah.
So, but it's more than enough time for you guys to finish the project.
Yeah.
And then refinance and pull your cash back out.
I mean, Jay's making a decent point. I mean, we can see it now in the market. I mean, people that are doing value add, where they're relying on either hard money or some sort of construction loan. I mean, they're definitely readjusting. They're pulling back, and especially if hard money rates are in the teens, that's going to make doing deals really hard. And we're hearing that a lot, and we're hearing that they're going to have to actually put money in to do a cash out. They're going to have to do a capital call after they're done with the job. If they pay these interest rates, they're going to finish the construction, and in most scenarios, they do a cash out refinance. But today, it's they're going to have to actually throw money in from investors to get a cash out. They're not going to be able to get a cash out to pull out. They're going to have to.
You're saying on
put money in.
construction.
They're going to have to put money in. Like, there's going to be no room to pull out any money.
Can you imagine doing a deal where you buy it, you vacate, you redevelop, you go through all that headache and costs and just putting the deal together, only to be done with it, and you need to put more money in to put permanent financing on it?
And that's that. I think that right there.
Is that a real scenario?
I mean, I haven't seen that scenario
Yeah.
yet, but I mean, it's likely.
No one's going to do that.
Oh, and it's not yet. It's people that are buying deals now that are going to start construction, like call it in a few months. They're worried about that in like 6 months from now when the job is done.
Are you worried about that on our deal?
Am I worried about on our deal? I think we have a lot of equity in our deal, and I think you and I have different circumstances where that was a 1031, and we'll get out what we can get out.
I was running
okay with
numbers.
it.
I was running numbers on our deal
Yeah.
last night, and even on like discounted rents, our projected NOI at a much higher interest rate, we have no problem with the cash out refi.
We also have a lot of cash in the deal. I mean, we have a low LTV right now.
We're going to finish the project with a low LTV.
and
Correct.
a lot of people just don't
But
have.
that's not necessarily true, because if you look at it from the bank's perspective, we're still getting like 70% loan to cost. So how could you say that we have so much equity in the deal?
We also bought very well, Derek. I think.
So you're saying because we bought it well, that's holding down the financing? And
I think a few
that's
things.
When
We're putting
see 70% loan to cost.
Hold on,
like,
too. We have a lot of cash in the deal too, right? Like we took a low LTV to buy it, right?
Yeah.
We're also taking. We're not even taking a full loan for the construction. We're coming out of pocket a lot for the construction too. So I think on both the acquisition and the construction, I think we're pretty.
point.
I think we're pretty conservative, and yeah, we'll have some room there. But a lot of investors are buying deals where they're coming to the table with. I've seen loans for 80% of the actual acquisition, and they're taking more to do construction. So they're heavily levered going into these deals, and there's not a whole lot of room to do a cash out after you do that.
Jason, any opinion on that?
I mean, I've seen a lot of deals. I've been canvassing a lot of lenders who were making these smaller type deals where they're the 1 to 4 families, and they were able to get 80% financing in the acquisition and 100% financing on the construction. And you try to pencil it out, and it doesn't work.
On the refi.
On the refi.
Yeah.
Yeah.
Mm-hmm.
So, yeah.
So what happens then?
Honestly, I don't know.
Yeah.
So there are some new lenders out there that are offering these DSCR type loans where they only use the taxes and insurance expense towards the income, and they base that NOI based on that, and then you could use an interest only option based on that. So you could basically take whatever your interest only payment is divided by your expenses of just taxes and insurance, instead of using the water and sewer, the repairs and maintenance,
Wow.
the management, the vacancy factor, all the other expenses that you typically have to add in to price out a deal. They get rid of that. So, and then so you refinance that. You could refinance it at full market value after 6 months of ownership, but the interest rate is much higher than what a community bank would offer.
But for the debt service coverage ratio, they're not looking at it fully amortizing. So
they're not. No.
Yeah. So therefore, the cost of debt is much less, and therefore you can get far higher financing.
You can get far higher financing, but you're going to be negative because all
Negative
those other,
what?
As you're going to be coming out of pocket. Yeah, you're
Negative
coming out
cash
of
flow.
pocket
To pay the other
feed
expenses.
the mortgage. Yeah,
Got it.
they're risky loans.
But why would a bank do that? They're doing it for the interest rate?
So I wouldn't even call them bank. They're hedge funds that own these. That that do these funds that just, that buy these packaged loans and they sell them on a secondary market. So
it's just asset-backed securities.
yeah.
How long of a term would this type of loan be?
I'm doing a lot of them. They're 30-year fixed rates. It's 10-year IO.
10-year.
Yeah, but the rates are
what are the rates though?
the rates are today. I quoted a deal like 8.125%.
Yeah, that's heavy.
Yeah.
Yeah, but it's
Interest
IO.
So
only.
heavy though.
So it's equivalent
But it
to,
can get you
depending
out
on
of
the
the
loan
deal.
size.
Yeah.
And it's equivalent to like a what is it, like a 6.5%, 7% interest rate, which is kind of market now, but
Kind of, yeah.
Yeah.
So on the higher end, right?
yeah.
I mean, where are our rates right now? I mean, obviously we had a little dip today, right? You were talking when we came in.
Yeah, I did a little rate survey 2 days ago. Everybody's multifamily rates are around 6.25% on 5-year money. 6.25, 6.5.
All right.
Some lenders are at 6.75.
Let's just give some context to this real quick. We're in November, early November of 2022. So 6.25% in November. And I mean, you sent an email before we got on the podcast, but you're saying where rates were earlier in this year.
Yeah, I mean, in January, February, I was closing loans at 3%, 3.375% on 7-year money.
Do you have any just like broad thoughts on like what that increase in the interest rates does to like the market in general?
I mean, it just makes deals much harder to do, much
Okay.
harder to finance. The last couple of refinances that I looked at required a significant amount of cash in. If you're coming from 3.25% debt, 3.5% debt, and you're going to 6.5%, the numbers don't work. I mean,
Yeah.
everybody who's looking for max proceeds, lowest rate, 125 debt coverage on a purchase, you're using pro forma numbers. You're not even using the actual expenses. All right, so now you're going to do a refinance in 5 years. Now you know what the real cost of the building costs to operate, which are far higher than what pro forma numbers are on everybody's setup, on my setups, your setups, everybody's setups. So now you're using the actual, you're trying to get to a 125 coverage
On
at
the
a
refi.
6.5% rate. You're just not going to make it. Like, you're going to have to put money into the deal to be able to go for that option for the next 5 years.
I will give you another quick nod real quick. Not that we have a whole lot of properties, but we have a few because we think it goes hand in hand with our brokerage business. We think it's an important piece of being a broker is to invest. But you got us a cash out refi on that 5 unit that we own,
Yeah.
and that's closing I think next week. So, and I guess to just give ourselves a little credit, it's a full cash out. So
We're lucky that we did that,
Yeah.
because
We got a good rate.
you're going to close at a 5.35 rate, which is
Yeah.
a great rate today.
I'll take it.
Any rate from last month is a great rate.
All right. So we're gonna bounce around a lot in this conversation. I know for sure we're gonna bounce and
Fine.
we're gonna come back to stuff and cash in and amortization and interest rates. I have a lot of notes here. But before we get too deep into the numbers, I just want to take a step back. Because again, we've appreciated what you've done. So I just want to get a sense of like what makes a mortgage broker a good mortgage broker.
So it comes down to relationships.
Okay.
It's always been relationships. When I first started in the business, I didn't understand it. I didn't know anything about commercial real estate. I didn't know about commercial financing. And my former partner / mentor told me he pushed relationships at all costs. He's like, just take out all the bankers, learn what products they're offering, go out to dinner with them, have drinks with them, be friends with the people that you do business with. And that's really what it comes down to. It's always a relationship. Having the ability to call the chief lending officer of a bank and getting a rate right away instead of going through the channels of a smaller loan officer that has to go up his channels to be able to get something done. There's value to that, and also understanding the client's needs. Like, if you guys are thinking about refinancing year 2, year 3, I'm not going to stick you in a 10-year loan with a 5.544332211 penalty. We're going to talk, 3-year with a 3.21 penalty, or a 5-year with like a very flexible 3.11 penalty or a 0 penalty. So it's really identifying the goals and the hurdles of what your objective is and what we're trying to do here. So it's always about figuring out what the end game is.
And for the owners out there, the investors that think, I'll just go to Signature, so they see Signature downstairs, or I'll just go to New York Community Bank. They have branches, throughout the market. Why should someone hire a mortgage broker?
So New York City is a very mortgage broker friendly city to operate in. There's other cities like, in California that they just go direct to customers and they don't use mortgage brokers. So New York City was built on mortgage brokers, and we have the ability to go out to the market to 10 to 15 banks, one email blast or one shot, or if I have to go to that minute. But like it's basically just understanding what the banks want and giving them the product that they actually lend on, instead of wasting their time and sending them something that they don't lend on.
Yeah.
But going into what Jay's saying, I mean, obviously I agree. We're brokers, right? And I feel like when we get hired to sell a building, sellers should hire a broker. They net more money,
Yeah.
and they're not dealing with it, and they don't do this for a profession, and they're not dealing with buyers day in and day out like we are. Same thing with mortgage brokers. I mean, I think you go to mortgage broker for ease of execution, organization. I mean, a good mortgage broker like Jay has relationships with these banks. If there's an issue, he's going to be able to get it through. He's dealt with them time and time again. He knows who to call, what to ask for, what not to ask for. And you don't have to deal with it. There's no way in any loan that we've done personally on a refinance or an acquisition, any of that stuff I want to deal with. There's no way I want to be dealing with that, and I don't know how to deal with it. So I don't see doing a deal without a mortgage broker. I know people can. If you have a really good relationship with like a Signature or a First Republic, I'm sure you can go in there and do a deal, but it's not something that I would want to do, and most of our clients don't want to deal with that either.
But even at the end of the day, I mean, each bank has their own terms,
Yep.
their own rate,
Yep.
their own products. So they're in the market every day. They can guide their clients to help you where you need to be.
Yeah.
And also, you need to understand that every bank, like you were saying, they have different ways of underwriting. They have underwriting rates. They, either they underwrite at a higher, 1% above their actual rate that they're offering. Those little things bring value to me to be able to bring to you and say, all right, this bank can offer X, but then I know this bank doesn't use a higher underwriting rate. We can get a little bit more here, and I think this would be a better fit. Or if like the building has a lot of violations and they're a little bit more lenient here, they'll do a small escrow, a small holdback. I think this is the best fit. So I always bring all the options according to how the deal is getting put together.
Yeah.
So I think that's the value that a mortgage broker brings to investors.
Very nice.
I'll tell you this. Our first deal we did with Jay in Jersey, it was not our first deal with him, but we bought that deal in Jersey. I mean, that was a pure relationship between Jay and that bank that got that deal done as quick as it did, and it was easy. When you're dealing with people, when there's relationships involved, and it's just a better experience.
Yeah, it's true. The relationship has been really valuable. When Jay can go to bat for his clients and basically tell the bank who these people are, and then that in our case, I can speak to our example, that's allowed us to build relationships with banks, and now the banks take us more seriously.
And listen, owners are scatterbrained. A lot of these people that own a ton of buildings, they're scatterbrained. They have so much going on. They're not organized. A good mortgage broker is organized. They have your paperwork ready. It's already filled out from the last deal. Like, they have your summary, they have your bio. It's just easy. And if I was asked for that, or if any of our clients were asked that every single time, it just would take forever.
Yeah, it's just the first time you deal with a new client, you just have to get all their information, and then once I have all the information, all I have to do is update it going on to the next deal, which is just makes life easier for everybody. So technically, it's like I'm buying this building. Here's the rent roll. Here's this. All right, I'm gonna off to the races. I'm gonna go to market.
Done.
Get you the terms, and then we agree on terms, and then I'll see you at the closing.
I have literally shot him client rent rolls, and I have offers back that day. Just a rent roll. I mean, these are preliminary LOIs, but that's all I need, and it's easy.
Yeah, and it's also good when we have our buyer clients that we can refer to Jay, and they're in good hands as well, and I'm sure they really appreciate that as well.
Yeah, I mean, it helps. It also helps you guys because you can eliminate the people that don't have the available cash that can put down on a building that has huge upside and low rents. You can eliminate a lot of people.
For sure.
100%. All right, so getting back to just the markets and the numbers. So I touched on this already, but the Fed raised rates by 75 basis points last week to a range now between 3.75 and 4%. I feel like everyone just talks about the Fed funds rate. Like it's what's in the news. It's what everyone talks about. But is the Fed funds rate even applicable to investment property financing?
It is.
Okay.
So the banks can borrow from the Fed. So that's their cost of capital. So then from there, if it's 3.75 or 4%, they have to add their spread above that to cover their cost of their doing business. So if their cost of capital goes up, then obviously the interest rates go up. So instead of the banks borrowing from the Fed's rate, they borrow from their depositors. They raise deposits and they have to they leverage their deposits, but to keep those depositors, they have to be competitive in giving the same money market rates that everybody else is offering. So when I speak to some of my bankers and they're at the smaller community banks, they have great deposits from elderly people. And they like it simple. They like to put their monies in savings accounts, money markets, very simple, where the money's not locked in, or CDs locked in for a year. And that's their nest egg that they have. Like, this is their money that they have forever. The older people.
The older people, yeah.
Like, people in general. They want to go where the highest yield is.
Yeah.
So if Bank A is offering 1%, but Bank B is offering 3.5%, where are you going? You're going to pull it out of Bank A and give it to Bank B.
Yeah.
So now Bank A is lost deposits. So they have to continue to compete to be able to give these depositors higher yield on their money. So that means their cost of capital goes up, and that means your interest rate goes up. So if you noticed in the past year or two, the banks are begging for deposits, literally begging. Like, they're calling up clients, calling up borrowers, just asking them to move money into the bank. We're offering a 2-year CD at 3% or whatever it is. They need to leverage those deposits to be able to continue to do business, because they're not those banks that are you're going to walk into, a Chase or a Bank of America where they're on every single corner. These are the banks that are located on the third floor of this building, and they don't have any branch presence, and they can only rely on doing business by making loans on commercial real estate.
So the banks borrow either at the Fed funds rate, or they borrow off of their cost of deposits,
or they leverage off their deposits.
So,
or there's also some central banks that they borrow from that I don't know what they dictate what type of rates those are, but that's also the cost of capital.
So then why do we hear all this stuff about, like, the 5-year, the 10-year, the prime, the FHLB? Like, how does that all play into to where banks are sizing up these deals?
So those are all indexes, and some banks do a spread over the 5-year Treasury index. Some banks, it's quoted spreads over the 5-year Federal Home Loan Bank. Every bank is different. Depends on, I think, their charter or their regulation or something like that. I'm not too sure about that.
So, all right, if the Fed,
but they're pretty closely tied to each other. So if sorry to cut you off.
No,
the
it's
5-year
okay.
Treasury is, I don't know, today was
it was 4.3 yesterday.
It's down. I think it's like 4 right now.
Okay.
So I think that, like, the 5-year Federal Home Bank is off by maybe 10 or 15 basis points.
Yeah.
So it's really, I think, the bank's preference on how they quote those deals above whatever index they use.
Do you have an opinion on? And I mean, obviously I don't know if anyone could know this, but do you have an opinion on how high the Fed is going to raise the Fed funds rate?
I have no idea. I'm hoping that with today's numbers of the CPI index, that being lower.
So let's just
What
explain
was it,
where
like
we're at.
7.7 today, they said?
Yeah, it went down like 0.2, right, or something like that. But it's a start, right? I mean, the market rallied like
Did it?
crazy. Yeah, the Treasury started dropping. I mean, the 10-year was down 25 basis points today. But it's a start. Like, hopefully it's the start of a downward trend where the Fed can kind of say, all right, we can ease up on raising interest rates, or instead of doing the 75 basis point interest rate every month, let's lower it down to a quarter. So
that would be a good sign for the market.
Right.
But in short, if the Fed continues to raise their interest rates, then we can expect the cost of borrowing to continue to go up, because it seems like all these other indexes move somewhat along those lines.
Correct.
All right, cool. So I got a few questions. Again, this is going to bounce around a little bit.
Yeah.
And I guess we already touched on this a little bit. I'm going to ask it anyway. The majority of your business right now, acquisition financing, refinances, and how has that changed over the past few months?
So it's half and half.
Okay.
I looked at all the deals I closed last year. They're mostly refinances. And this year, the majority are purchases. But lately, they've been mostly refinances.
Got it. let's talk about all these loans that are scheduled to come due. At least the initial term comes due in 2023. We're talking about like 2018 caliber loans. I feel like there's a lot of issues around some of this, and I'm just wondering, is it really an issue or is it not? I'm wondering if, like, in our heads we're making a scenario. And let me just say a little bit more before we get into it. Like in 2018, that was before the rent laws changed, and these rent stabilized buildings were appraising at 4 caps, and people were taking out max financing, 75% LTV. I don't even know if LTV is a real metric. I know last week we talked about metrics such as price per unit, and we said price per unit is a throwaway metric. I feel like LTV might be a throwaway metric, but I'll let you touch on that in a second as well. But I really want to hit on these loans that are coming due in 2023, or that I guess you could say not coming due, they're resetting. They're going into the extension period. Any thoughts on that segment of the market?
Yeah, so I was working on a loan that is set to reset next year, and we were looking to refinance earlier, and the rates, they jumped up, and before we were able to execute, we were able to get enough cash out to cover closing costs to redo the refinance, but then a week later we weren't, and it would, he would have to require to come out of pocket to do this refinance. So he still has another year left, or 6 months left, and it's kind of like pick your poison. So either you pay it down now, a little bit less, or you pay down more next, the next 6 months. As far as like going forward, I think what I've heard is that a lot of the banks that are kind of anticipating that already, and they're working with their borrowers. So if they're, let's say they're 250 or 300 over the 5-year Treasury on the adjustment, they're working with them to bring it to an acceptable rate to the bank, as long as it meets their minimum debt coverage ratio, and they're going to set on that. So instead of it being 7.5%, give us 6.5%, and it still meets the debt coverage. Let's just do it this way, and we'll put it away.
And those will be
next 5 years.
Fully amortizing, or would the bank consider going to interest only?
It usually would be fully amortizing.
Yeah.
Why doesn't the bank do that, Jay? Like, why? It's an easy out.
You're saying go to interest only?
Yeah, they win because they make money on their interest, right? Not their principal, not paying down the principal. So it's a good deal for the borrower. It's a good deal for the bank. Why not immediately?
Because the regulators,
Yeah.
they have heavy regulation. They go through the files, and they have to justify why they're giving this borrower interest only. And if they can't really justify it, then I don't know if they downgrade the loan, but they don't look at it too fondly.
How does a bank, like I hear like a buddy of mine just got interest only on a deal for 2 years. How does a bank justify giving someone interest only?
The only way they could justify it is if it's not meeting debt coverage, or they got an exception, or there were issues with the building, or there could be a variety of things that they would give it. But a lot of banks don't want to give the interest only anymore.
So, but before so we're talking about like commercial financing, which is properties 5 units and up, and you're saying they don't want to give interest only on that stuff. They want amortization. And honestly, I don't blame the bank for wanting amortization, because if I'm the bank, like, of course you want to get your interest rate.
Yeah.
But you also, especially in the current environment where cap rates are up so much, like,
you want that loan paid
I mean,
down.
if you were at 70 or 75% LTV, now you could be at 90% plus LTV. So you want some principal reduction
Some skin in the game.
built in there.
Yeah.
So basically you're saying that the banks are willing to modify the terms of the extension and give a lower interest rate than what's
written in the note.
What's written in the note in order to accommodate, is it to accommodate debt service coverage ratio requirements?
I think so, yeah.
So-
What if it doesn't cover it?
If it doesn't cover, then it's like it's a technical default.
Yeah.
So
So,
So
they may require the borrower to pay down.
all right, so
Okay.
this is my question. So in these extension periods, and you may not know the answer, I don't know the answer, but in these extension periods, are there debt service coverage ratio requirements?
Yes. It's all over every single paper you sign.
Can we elaborate on what that looks like in these extension periods?
So in the extension period, if you're doing it coming out of a 5-year loan and you're going into another 5-year option, you're actually amortizing at 25 years now. You're not even getting the
resets
full
the AM.
you're not even getting the full benefit of a 30-year AM, because you're at 25 now.
So that hurts your DSCR even
Yeah,
worse.
of course.
Yeah.
So you still need to meet a 125 coverage, which is if you maxed out that building at a 125 at a 3.5% interest rate, you you better have brought those rents up, 20, 25%.
So if you don't have a 125 debt coverage ratio, you're in technical default. All right. Let's just talk this through. Let's put an example here where someone has a 10-unit building. They bought it 5 years ago. I guess 5 years ago was 2018, right? Mm-hmm. So let's just say that they got some apartments vacant. They did some individual apartment improvements to some units. Whatever. They like added some value. Now, in this scenario, their loan's coming due. It's rolling into extension. The interest rate is higher, and the amortization is less now. It's 25 years. And let's just say they're not hitting the 125 debt coverage ratio requirement. So they're in technical default. What is the bank going to do?
So I guess what happens is they mark that loan, meaning like they're not going to default him on the technical default.
Yeah.
But they can if they wanted to. If they wanted to sell that loan in default to an investor who wants to buy that loan, they could technically default that loan right there because of that technicality. But what would probably happen would be the regulators would mark that loan or downgrade that loan. They would have to set aside some capital to just in case if that loan did go into default, and it'd be a problem for the bank, and they would probably try to unload the paper.
Well, the issue that I have with that for the banks is we're in such a highly regulated market and environment where, we sell these buildings, okay? And we go to sell this type of building, this 10-unit with, partially deregulated units and partially rent stabilized, and there are IAIs. Buyers are extremely meticulous about going through the records, the proof of payment, the plans, everything to substantiate the individual apartment improvements. But the operator, the building owner, is the one with those documents. The bank doesn't have it. So now all of a sudden, the bank has this loan that's like in technical default and maybe has a little bit of a higher LTV than what they want. The bank is in a very bad position because without the owner's cooperation on the paperwork, that bank's loan, the paper is very hard to like demonstrate what it's worth and what the asset is worth. Just because there's so much due diligence and paperwork that's required. So I think the banks would be really foolish to like start pressing these people too hard, and I think the banks really should encourage cooperation with the operators and not holding them up on like technical default and stuff. But
it's the regulators, right? That's what you're saying. The regulators force them to do this. Obviously, the bank, I would assume, they understand how to make a decision and a good one.
Right.
But if the regulators are down their throats downgrading loans, is that the issue?
Yeah, if they downgrade the loan, that means they have to set aside additional capital, which pulls away from their ability to lend because they're now setting aside money.
And they want that off the
And
books.
then it's not just one. You're talking about 100. That's a lot. So it has a trickle effect.
Yeah.
So these loans go on a watch list. These loans are being watched by regulators. Who are these regulators?
I don't know. The bank regulators
bank regulators.
Yeah, they do these exams. I think every quarter, and they go through all the loans in the portfolio that they're holding, and they stress test these loans, and they go through the historical tax returns, and they go through the expenses, and they want to make sure that they're meeting on 125 coverage.
So I have a different property. We've talked about this on the podcast already, but I'm going into option period in like a month or two. I don't think I meet the debt service coverage ratio requirement.
All right, so we could have another podcast on that and see how the bank handles it.
We will see what happens there.
To be continued.
Yeah.
100%.
What are you going to do? I think you have to pay this bad boy down.
My plan all along was to just let it go into the option period and just like...
But it doesn't cover in the option period.
I don't think it does. In fact, I'm pretty sure it doesn't. But
it doesn't.
I don't think it does.
You looked into this.
I believe that I
believe
rough.
I kind of think.
I think I ran rough numbers on it, but I didn't really look at it too closely because I always thought that I would just like kick the can down the road.
And to your defense, that was not a high. You took a conservative loan there. You could have taken way more on your cash out. And
the issue
right?
is
2015.
Dude,
I remember you doing
this up
that
again.
No, I know, but you took a conservative loan there.
The issue is my taxes went up a lot.
Yeah, they did.
I lost all upside potential in the deal. My cap rate surely went up. Now the interest rate's going up. So it's just I'm just getting hit from like every angle.
It's not fair to you.
But I got a call from a guy today. This was very interesting to me, and it just gets me thinking because this is what like everyone's talking about. So this is a private equity company. The guy calls me this morning. He's like, hey, I need to talk to a broker in New York. He's like, I got a pool of loans on my desk. He's like, I have several loans direct from banks. So there's no broker. The banks are just going to this private equity company. He's like, the loans are in default. And he's like, I'm looking to buy these loans, and I just need to know if I'm making good deals or not. So the first deal he brought up to me is a 6-family in Bushwick. He's like,
no addresses here, okay?
I don't know the address. Whatever.
Okay.
I don't care.
It's not a big street.
That's Ocean Hill.
Hang on. He called. He's like,
Okay.
He's like, you guys just sold the deal? I'm
Yeah.
like, well, I think we did.
That's for 625.
Yeah, he goes, you just sold the deal
we
for.
sold that?
He goes, you just sold the deal for $625,000.
Did we
I'm like,
even know that?
I'm like, that sounds right. He's like, well, I got a loan here. He's like, it's in default. It went like it's past its maturity. The guy hasn't paid it back. This is like this private equity guy. He's like, the appraisal says that it's a free market building.
Okay.
I'm like, I'm like, just like the broker's setup says it's a free market building.
Yeah.
And he's like, should I buy this loan or not? And I'm like, how can you buy this loan when you don't have any paperwork and the owner's not cooperating with you? I'm like, you don't know if it's free market. You have no proof of individual
family?
apartment improvements. You don't have a sub rehab certificate. It's a 6-family. The loan is $500,000, so I'm saying like at least it's low enough. He's like, yeah. He's like, the appraisal in 2018 was for 1.3, but it says it's free market. But like the point that I'm trying to make is like,
I actually know the deal. I'm not going to obviously say it, but
Interesting.
I know the deal, and so do you.
I don't know it
I
offhand.
know what it is, but we're not going to go into it. But yeah.
the question is, I'm sure maybe one of our listeners knows, so I just gave all that away.
Yeah.
Maybe I'll have to bleep out the address.
Yeah. Well, the street name. You didn't give the
the street name. I don't know the address. But how in the world can someone buy that paper when there's just so much that they don't know about the deal?
Yeah.
Would you buy a 6-family blind for $500,000?
No.
Not knowing anything about the deal.
Listen, there's a time and place. 500, right? I mean, if you have some free market units, if it's fully RS, no.
You don't know.
Yeah,
they say it's free market.
It's definitely not 100%, because why would the loan be 500 if it's 100% free
for
market?
sure.
It's the lowest LTV loan I've ever heard.
For sure.
Right away, you know that that's not true. But yeah, it's not.
So I don't know. Any thoughts,
I mean,
Jason?
whatever's in the loan file. I mean, he's gonna get a loan file to see what was submitted, and then you have to do his due diligence and see if he can recoup that 500 over if in fact it is a free market.
I know on my buildings, I never submitted like how I raised the rents. Maybe I gave updated rent rolls, but that was it. So like they're just basically taking the owner's word. But I wonder if an owner would just like raise the rent or do it illegally, and like you don't have paperwork to substantiate it. And there's a lot of rent overcharge exposure there on the deal. And the lender, and call it, I don't know who you call the person that buys these loans, the predatory person that's going to charge the default interest rate. They'll never get that documentation.
Banks are, sorry to jump in, but banks are catching on with this. I remember we looked at the deal like last year. 6-family was completely rent stabilized, and there was a little overcharge in one of the units. The bank caught that, and they escrowed for that. They took down the proceeds, right?
Yeah, no, the banks are on the up and up with rent stabilization laws. And
Got it.
They actually, I was working on a deal where the buyer wanted to. It was a rent stabilized building. The buyer wanted to change the perimeter of the apartments.
Okay.
And I'd used the projections to send to the bank, and like this is what we're looking for. And the bank's like, we don't believe in this. Like we're not going to give you that free market rent that you supposedly get, the first market rent when you change the perimeter of the.
Let me stop you. This is very interesting because this is a question that I have. I mean, you're referring to Frankenstein units. This is a bet. Obviously, the real deal calls it like a backdoor option, but this is legal, and people are doing it, and people are combining units, and they're attempting to set a new market rent. And I've always wondered myself. I said, when these things, I haven't seen one on the market, so I don't know how a buyer's going to react to it. And I always wondered how banks going to react to this. So not well, you're telling me.
I mean, I didn't do the deal.
Okay.
That bank, I relayed that message back to the buyer, and he went on, and I don't know where he got the financing from, but some banks do offer it. Some banks can do it, and if they're not on the up and up of the rent stabilization laws.
So
interesting.
So Jason, when all these loans roll, the next few months, they're rolling now as we speak. I have one that's rolling as we speak. Is there like a mass foreclosure scenario or like a mass deed in lieu or like loan sale scenario that's like on the horizon?
I can't see it. I mean, you're talking about every single loan in New York City then. I mean,
correct. You're talking about every single loan.
Every single loan.
Yeah.
Well, not every single loan. What do you mean?
A lot of them. I mean.
Well, Here's my opinion on this.
Okay.
I was speaking with a buyer that bought a building. It was a rent-stabilized building like 4 years ago, and he was like getting max financing, super low interest rate, like a very aggressive loan.
Okay.
And I said to him, like, doesn't that make you nervous to like be leveraging this thing up so much? And I'm like, what if interest rates go up? I said this a few years ago. I'm like, what if interest rates go up to 4 or 5%? I'm like, it's gonna be very bad for your deal and your loan. He's like, look, he's like, if that happens, he's like, I'm in that boat with everybody else in New York City. He's like, we're all in the same boat together. He's like, we already got a bailout in 2009 or whatever it was. He's like, there'll have to be something to bail us out again. He's like, we're all in the same boat together, which like just gets me to think like, dude, the government created this whole environment where like interest rates are so low and everyone like levered up like crazy, and like it just fueled the entire like economy for assets. And now the government is the one changing the interest rates, doubling the interest rate,
So,
having
like,
profound effects on borrowing and asset value.
It's a light switch. It's like on, off.
And we're
on,
all
off.
just like we're just all going up and down with them.
Yeah.
We have no say in it. I mean, we just have to adapt to the market. And
So yeah, there can't be
figure
this
it out.
mass foreclosure.
You got the
scenario.
same rhetoric when the rent laws changed in 2019. Like
Yeah.
any loan that was due in 20, 21, 22, everyone was like, there's going to be a huge foreclosure market. Funds were raising billions to buy over these. None of it ever happened.
Steve,
I
I'm just looking at you. It's an excellent mustache you got on right
Thank you,
now.
thank you. It's
Well,
November.
He did clean it up.
It's for November.
When you came in this
You
morning,
got
there was like
the-
a light around your face.
The
You
clean,
cleaned it up.
the clean shaven face
Yeah.
and the mustache. We gotta get
Looks good.
It gets occasionally where I get a beard, so I have to trim it down.
There's a lot of
every day.
mustaches in the office right now.
It's November.
Well, you know why? You know why the girls love these mustaches.
It's also Top
I've heard,
Gun.
yes.
It's tough,
I don't have one personally. Maybe I'll have to cut one by the end of the month.
I'm not gonna lie.
I'm not falling into it, okay? But
No?
the guy, I mean, I forgot his name. The actor from Top Gun.
Tom Cruise.
No, not Tom
No,
Cruise.
the other
His
guy, okay.
protege.
All right.
The younger guy.
I don't know.
He had a mustache, okay?
Teller.
Myers, yeah. Thanks to the camera guy over here. Miles Teller, okay? Miles Teller. He looks phenomenal.
All right, so
and the girls love it.
So where do we leave off now? So we're not gonna have a mass foreclosure scenario, right?
No, the banks are going to work with everybody. At the end of the day, that's what they have to do. They have no choice. What are they going to do?
You're right.
I
The
have
whole
a-
portfolios
well,
they
it's-
go under, and they're going to lose all their
Yeah.
income.
And there's
interest
certain
income?
areas
Come
too, like Upper Manhattan, Bushwick, all these areas, like
Central Brooklyn,
Central Brooklyn,
South
every
Brooklyn.
loan. It's every loan.
Yeah.
You're right. In certain areas, it's every loan. Are rates going to come back down? Like, what are your thoughts on that? Obviously, you don't know, right? But if rates, let's say rates are going up the way they are, right, and they're going to shake out somewhere in the 7s next year, and right now they're in the early 6s. You said 6.25, and people bought on when interest rates were like low 3s when they were very, very low. Like, are they ever going to come back down, or is that just wiped out? Like, it's a scary
knows?
thought.
Who knows?
Yeah.
And that was one thing. I mean, obviously, I'm young in the, I've been a broker for 11, 12 years now. But when I was young in the business, my dad, he's a doctor, a conservative guy. That was the one thing he said to me. He's like, wow, he's like, rates are in the low 3s. People are buying on these rates. He's like, they'll come up. He's like, you're not my age. He's like, rates used to be double digits. He's like, these are extremely low, and to be buying on these values. And I've been thinking about it a lot lately. I mean, this is a scary thing.
I was with early in my career. One of the first deals I closed back in 2010.
Yeah.
I went to lunch with the buyer. The guy has 30 buildings privately in Brooklyn, sizable owner. So I'm sitting there at lunch with him and just talking about real estate. And he says, look, he's like, the key is don't over leverage. He's like, I never put more than 65% on any of my buildings.
Yep.
He's like, because the market goes up, the market goes down. He's like, don't over leverage your assets.
Two of the biggest owners that I talked to that I really respect both said that.
Yeah.
Never over leverage deals. You never do it. And the guys that own forever, like the big guys, the guys that have 4,000 or 5,000 units that have been through every cycle, they don't have high leverage on their deals.
So I have a deal example here, and I guess we already touched on this, but I still just don't quite understand the mechanics of this stuff. So I just wanted to run through this deal example and some numbers and see what you guys think about this. I was on the phone with a guy in Brooklyn yesterday. He's got a 7-unit building. It brings in $24,000 a month. All right, so it's $288,000 per year in gross income. Call it $290 gross.
Okay.
It's got a $240 NOI. Okay. And he's got an existing loan of $3.1 million at a 4% interest rate. His cost of servicing the debt is $180,000. So it's $180 debt service on $240 NOI. He has a 1.33 debt coverage ratio today at his 4% interest rate. And he has $60,000 of net cash flow after debt service. Now, if he were to refinance the deal today, if he had to refi and get a new loan, at a 6.25% interest rate and a 1.25 debt coverage ratio, 30-year AM, the most he would get is $2.6 million. So he has a $500,000 shortfall in that scenario. So there's your cash in refi example again, which I don't see why people are going to do that. Now, let's just say it resets, okay? He told me that his reset period is 175 basis points over the 5-year treasury. So I put this on paper yesterday. We're going to use yesterday's numbers. 5-year treasury was 4.3 yesterday. So the rate in his extension basically goes to 6%, which isn't bad. It's honestly less than because he's got only 175 basis points, so it's very good. But in that scenario, the annual debt service goes up from 180 to 225, and his NOI is 240. So he's got 15 grand of net cash flow after debt service. The cost to service the debt is up 45K, and now his debt coverage ratio is 1.06.
Why is it only 6% though on the rollover?
Why is it only 1? Well,
6%.
he negotiates. This is a sizable landlord.
Ooh, so
he might have some
negotiated.
sway.
Oh.
But he negotiated for 1.75 basis points above the 5-year. Now,
that's good.
I'll give you an example. Me, on the other hand, and the loan that I'm dealing with, this was one of the first refinance I ever did. I just took what the bank offered. I didn't even think about it. I thought I'd refi and it would never be an issue. But my loan is 275 over the 5 years. So for me, that interest rate would be 7%.
Yes.
I ran his numbers as well at 7% just to see what that looks like. But in the first example, he's at 6% and he's at a 1.06% debt coverage ratio. In the second scenario here, where let's just say it's 275 basis points over the 5-year treasury like I do, his rate goes to 7%. His cost of debt service is $250,000 on a 240 NOI. So now he has negative cash flow on the deal, and his debt coverage ratio is 0.96. So,
But wait, did you run the numbers on the UPB after 5 years?
What is it?
Not you can't run the numbers on the original loan amount because he did pay down in 5 years.
So I have a
but
couple
it's
flaws in my
small-
underwriting.
Yeah.
I ran it on the original amount, correct. I should have, you're right, I should have
Use the amortization table.
amortized it. And also, I still used a 30-year AM, not a 25-year AM. But I imagine maybe at the 25-year AM...
It's going to be worse.
Yeah, so maybe like my numbers aren't that far off. But just like conceptually speaking, I just want to like... What happens to these guys? 1.06% debt coverage ratio or 0.96 debt coverage ratio. And I was speaking with him, and he's like, look, he's like, maybe there's an example where my rents could go up enough to offset this increase in debt service. And I ran those numbers too.
Would he know that by now if it's happening like right now?
Yeah.
He's not going to just raise the rents in like a day.
Basically, I mean, if his rents can go up, say his average rent is $3,500 right now. If his rents can go to $4,000 average
by
on
when?
7 units, well, that would offset this increase. Is the point they're making. But anyway, I just want to throw that out there, get some feedback here, preferably from Jason.
Yeah.
Sorry,
sure.
Luke.
No. Listen, I was just going to throw it in.
I mean, it's the same scenario. I honestly don't know what's going to happen. I think the bank is going to have to work with him to either work out an agreement to pay it down or even lower the spread even more and give him a better interest rate so he can meet the minimum debt service and he can just move on with the next 5 years. It's a tough scenario.
Would worst case scenario for the landlord be the bank sells off that the note, and then whoever buys the note goes in default for the higher interest rate and basically forecloses on that buy?
I mean, that can technically happen. Yeah.
That's probably worst case scenario.
But then the borrower's never going to do business with that bank again.
And you're gonna have a mass wave of these foreclosures going on.
It depends who the owner is, though. It's all profile. If this guy has a huge portfolio, like paying that down because he likes the asset and he's going to keep it, or he's going to sell it. I think in that situation, you either pay down the loan or you sell it. What else do you
But in
do?
this scenario, you can't really sell it.
He's talking to me about getting offers on it, and we have offers on it. So.
Yeah, and they're not looking good.
No, they are looking very good, actually.
So there you go.
Do you want to guess?
So the option should be
Do you want
selling.
to guess where the offers are?
At 240 NOI?
240 NOI.
What's the property? Like, just tell me don't tell me the address and all that. What is it?
It is a renovated 7-unit.
Gutted 7-unit.
Good location.
Okay, so 5 cap.
Pretty much, yeah.
Okay, so he's looking good.
Yeah.
But that's a good buyer.
It's probably like
That's a very good buyer today. There's not.
So yeah, we got a good buyer.
Yeah.
All right, we'll see. It's a big question hanging over the market.
Yeah.
So for the buyers out there today, like one of the things in this low interest rate environment, it's always seemed very easy to acquire a building as long as it hit obviously certain metrics like the DCR. In today's world, even if you get a good deal and it pencils out, can you still get 75% LTV if it meets the debt coverage ratio?
Yeah, of course.
Okay.
So you have to buy like an 8 cap.
No, a lot of
Yeah,
banks out there,
just gotta run the numbers
but like
on
a
it.
lot of banks are saying like we're only giving 60%.
It depends.
It depends on the asset. Multifamily, you can still go.
As long as it covers, though. That's the main. As long
All
as it
right, so
covers the new
let's
rates.
bring that up. I meant to ask you
Yeah.
that before. Is loan to value a throwaway metric?
It's not a throwaway metric.
Okay.
You still need to put that into your.
Why?
Because you still need to be limited to 75% of your purchase.
So if
or
you have a
less.
high cash flowing deal, they'll
Yeah.
only give you 75%. So that's where they cap out.
There's been deals where
Yeah.
it warrants higher than 75, but the bank never does that.
It's the lesser of.
Yeah, it's a lesser of. The bank needs to cap
You
it.
see that in the term sheet.
Yeah, and the bank needs to
Is
have.
75 like a hard number that like everyone uses, or would
Pretty
people go
much,
up
yeah.
to 85?
I mean, I know some of the agencies will go up to 80%. I've never seen anybody go to 85% on just a first position mortgage.
I've seen some 80s, but like he's saying, it's an agency loan.
Yeah. And you see 80 all the time in the residential space.
Of course you do. Yeah, it's.
It's a residential loan.
I mean,
Anything,
yeah.
anything you want to add on that?
No, I just.
I mean, on home loans, you can go 100% financing.
Really?
Yeah.
Yeah, I guess like FHA or whatever it is.
Right.
Yeah. I guess that answered all my questions.
Yeah.
Anything else that you're seeing? Anything else worth bringing up? Different asset classes, retail, land.
The banks are still a little bearish on retail, office, obviously, but you know the main asset everybody wants to lend on is still multifamily.
Yeah.
It's always been multifamily.
A big part of our business, obviously, as you know, is value add deals, right? So you have buyers that come in that are going to add a lot of value. So they're going to be taking construction loans, and then they're ultimately hoping for some sort of cash out refinance to put some money back into the investor's pocket. How are those deals going to look like next year? Or are those guys going to be on the sidelines?
I think the guys are going to be on the sidelines. It's really expensive to do construction loan these days, and you know if you're at prime, which is 7% plus 2, you're at 9%. And plus with the rising construction cost and labor cost and jumping through all the hurdles of trying to do something in New York City, it's not worth it.
So value add, it's going to be really hard. I mean, even if you come to the table with a lot of cash and you do the construction in cash, that's fine. But no one's going to invest that kind of money and not have some sort of capital event at the end to relinquish some of that cash.
Should always sell.
Okay, so so those are flippers.
Yeah, well, people want to make money.
No,
people
I know,
People
I know.
are going to find a way to get money in and out of deals.
So that's the only value add play is to sell the deal.
And you still have 1031
And
exchange.
you hit 1031, you do it again. So that makes sense. So what's the easiest loan to get done right now, and what's the hardest loan to get done right now?
Low leverage, multifamily loans are the best to do right now, if you can find them.
So someone that's buying a multifamily deal and willing to put down a lot of cash.
Yeah.
I think to piggyback, I think those are the buyers you're going to see come out of the woodworks these days. They've been outbidded by all these high leverage syndicates.
Yeah.
And I think they're going to see a market where it's a downward trajectory and they're going to get discounted deals, put a lot of cash down, refinance when the rates adjust.
And that's exactly when I was a mentee of Derek, when I came into the business, it was, right after, obviously it was 2011. So things were starting to pick up a little bit, but the financing was not great. And the people that were buying deals was all cash deals and very, very, very low leverage. So you saw a lot of the guys that we know that own a ton of buildings and they made a lot of money, but it was not the raised capital. There was one group doing that, and it was ZT. I mean, they're out of the market now. They sold everything, so I can say that. Dude, they were coming in. They were the
Raised
first.
capital?
They were like competing with the guys in Crown Heights that were like long-term owners, owned a ton of stuff, and they were raised money.
They were like the first syndicate.
When I came into the business, they were the first like syndicate that was making a splash, and they were competing with guys that were heavy on the cash and that had a lot of holdings, and they were making deals. But there wasn't a lot of syndication going on back then. I mean, you had two different types of buyers, or really, and then they were really one of those people.
Yeah.
But I think that's going back to the point. I think that's what you're going to start seeing. It's going to be cash heavy buys, I think.
Yeah, the guys that were sitting out of the market
Yeah.
for the last couple of years are going to dive right back in because they just couldn't compete with those high prices.
Yeah.
Even though the financing was cheap.
Mm-hmm. Yeah, and now prices look a lot better. So
Do you think there's a shot that that interest rates come back down in 2024? Do you how long do you see this going? What do you think about?
Honestly, I don't know. Everybody's thinking 3 years. So a lot of people taking 3-year debt and hoping that by that time the interest rates will start to come back down.
I think now would be a good place to cut.
Okay, cut.
So Jason Al Consultants.
Thank you very much.
Really helpful. Always appreciate everything.
Yeah, man, for sure.
We'll have your contact info as part of the show notes or in the Instagram stuff. And Al Consultants, if you'd like to speak with Jason, make an introduction. Very good mortgage broker. So really appreciate you coming and sitting with us today. And that was really helpful.
I appreciate it, guys.
Yeah. Thanks,
man.
Great seeing you guys.
Okay,
Appreciate it.
definitely. Okay, thanks everyone.